Austin, good to see you. Today we are talking through money market funds, the hottest investment that may end up costing you. Following several rate hikes by the Fed, money market funds are earning about 5% or more right now. They're so attractive that investors are holding a near record $5.6 trillion in money market funds right now. Well, these are seen as a pretty safe investment. I'd like to ask you about the opportunity cost of pouring this much money into cash.
That's the right word, opportunity cost. When we think about holding a significant portion of our portfolio in a money market fund, right, that 5% yield sounds very enticing. However, we have to compare what is it that we're investing for, right, our goals, and the lost cost or opportunity cost that we're giving up. We know that when we invest in a diversified portfolio over even a 5 or 10 year period, it is going to far outpace over the long term the return that we would be able to achieve in that money market fund.
I'm glad you brought that up then. So, when choosing how much cash I should allocate in my portfolio, should my first question be what's my time horizon?
I really do think that needs to be a main consideration because we know the most important component and why many of us, can carry or consider carrying a significant portion of cash for that rainy day fund is access, right? That liquidity. We want to know that should that HVAC blow out, right, we have cash on the sidelines that we can access for that emergency. But if we don't have that near-term need and the emergency fund is already funded, we really should not be making short-term investment decisions based on that potential 5% yield because of that opportunity cost that we just discussed. We
Mhm.
still want to stick with our investment plan and what we designed for the 5, 10, 15-year outlook.
Right. So just to kind of show everybody what that looks like, here's another visual from returns from 1981 through 2023, money market funds versus bonds versus the S&P. So as you mentioned, building an investment portfolio is the best way to preserve purchasing power over time, often your best hedge against inflation too. So are we being short-sighted if we're parking too much money in money market funds?
Absolutely, Aaron. I 100% agree with that statement because we know the biggest risk and one that we want to ensure we avoid as a retiree is running out of money in retirement. And really,
Mhm.
one of the biggest threats for retirees and running out of money is inflation. We need a diversified portfolio that comprises both stock bonds and a portion of cash, but really focusing on a component for that long-term growth to battle inflation so we do not run out of money is really so important, and not, again, making those short-term investment decisions based on the current interest rate environment.
As we mentioned, though, it all comes back to having a plan. So, Austin, if somebody wants to design that plan with you, what's the best way to reach you?
Yep. So you can give us a call at 919-322-4113 or shoot us an email at info@patriotwealthnc.com.
All right, Austin, thank you.
Thanks, Aaron.